The broadcast is now starting. All attendees are in listen-only mode.
All right, good evening, everyone. Welcome to today's sharing session over here. Okay, so for the past 1 to 2 months, right, since October, we've been running, okay, a series of sharing session over here, mainly covering on different strategies and techniques that you can actually use to analyze and trade the market. So today's session here will be covering on what I call it a 1, 2, 3, 4 strategy. Okay. Now you might not have heard about this name, but essentially this is a trend following technique. Okay. I would say it's pretty much objective in the way of how we approach the charts, and therefore this technique is very suitable for traders who are very new in the market. Okay, and what I'll do is I'll straight up jump into the charts to give you, straight up practical examples while we are going through the principles of how to trade this strategy over here. Okay, so as the name suggests, right, it's a 1, 2, 3, 4 trading strategy, and this is a trend following technique. In other words, if the market is not in a trending environment, okay, then we'll not get any execution or any potential setup using this method over here. Okay, and of course, this method here kind of objectify how we identify trend as well. Okay, so once you actually acquire some of the principles and the processes that we're going to share with you today over here, you'll be very clear in identifying like what market is in a trend. Is it right now like range, or is it uptrend or downtrend? Okay. And because it's a technical strategy, which means that it can be applied on any instrument, any asset, as long as there's a technical chart. It can be applied to any time frame as well. Okay. However, I personally do not suggest that you actually go below 1 hour time frame. Okay. In fact, I would say if today you are fairly new to trading, my suggested time frame is always somewhere between 1 hour and 4 hour. Would be the best optimized time frame for you to actually look out for trades. Okay, and of course, if you go up to too high time frame like daily, weekly, then it's a little bit too long for you to then find a trade setup. Okay, so a good balance to me, I always say, is somewhere between 1 hour and 4 hour would be most ideal for most people. Okay, so this strategy, let's get started. Okay, I would break it down into, I would say, 3 steps over here. Primarily here is to identify current market trend. Okay, and we're gonna share with you a very objective way of doing that. Once we do that, the next step is to identify the nearest structure level. Okay, and again, I'll of course show you how to do that. And last but not least, once we've done that, we'll combine a little bit, okay, on Fib to help us identify and execute, right, our trade. Okay, so essentially, if I break it down into 3 steps, these are the 3 components for this methodology called 1, 2, 3, 4 trading strategy. Okay, so let's get started with the first, right? How do we identify and objectify a trend, or how do we define whether the market is in an uptrend, downtrend, or is it in a range? Okay, there are few techniques over here, and there are some indicators that can use to visually help you. Okay, but I would show you the kind of like naked chart first, which means you don't put in any indicator, you just use price action to help you identify first, right? And then after I introduce to you one indicator that can potentially help you in terms of a visual aspect. Okay, so now when we identify trend, okay, I want you to see the market is never going to move in any direction all the time in a single direction, like continuously, right? It's going to be going up, coming down, going up, coming down, and it's what we call wave. Okay, and if you take a look at this, right, this is the current euro dollar chart. If you take reference to where we are right now, this is the low point. Okay, and you can see before the price reached here, it was at the top, right? So this was a down move. Okay, but before that down move, can you also identify, like, there's this little push up, there's this move that came down, there's this move that went up, there's this move that came down, right? So this is what we call waves, right? The market is never going to go in one single direction all the time. Okay, so you need to be very comfortable with that, and within this you can see, right, this came down, went up, come down, go up, come down, go up, come down, go up, right? And this part here is what we call swings, right? I mean, there are many different terminologies that you can name it, but for conventional purposes, we just call it swings, right? And market tends to move in swings. Okay, you can even break it into like smaller portion, and some of you might even see this as like just one. Okay, but some of you might see it as, oh, this came down, this went up, this came down again. So there are 1, 2, 3 swings, right? And some traders might just see this move here as one. Okay, now there is still that little bit of discretionary perspective of trading. Okay, you can't fully like 100% objectify that. So it might come with a little bit of experience as well. But to me, okay, whether you see this as a 1, 2, 3, or you see this as a one move, it's perfectly fine. Okay, it's not going to make or break your trading as a whole, right? Because this one here is just basically one small portion. Okay, now you need to be very comfortable with that, because the first step when we want to identify trend, okay, to give you a very quick understanding of what we define as an uptrend, is where we have these two components, right? The first component is we have a higher high, okay, and okay, the second component must be there as well, right? We need to have a higher low. Okay, so the keyword here is and. Okay, I mean, you can't have only a higher high but there's no higher low. That's not an uptrend. Okay, and of course, the opposite over here is we have a downtrend. Okay, and the downtrend is then defined as a lower low, okay, and a lower high. Okay, so same thing, you need to have two of this to kind of define a downtrend. Okay, so how do we identify like highs and low? We actually do that via what we call swing. Okay, so we always focus on the right hand side of the chart. Right now, price is here. Before it came down, it was at the top over here. So this was a down move. Okay, so this is what we then can start to see. All right, we have a low point here. Okay, we have a low point here, and we have a high point here. Okay, I think this should be quite obvious, right? So we have a high point, we have a low point. And then what happened before that, okay, we start to move a little bit to the left side. We start to see, okay, price actually went down a little bit. Okay, or I would say price actually came to a low point here before it kind of established this high. Okay, so what we then have right now is we have another low. Okay, and before that, price actually was at the top, right? So it actually came down, established this low, went back up, established this high, and then it continued to come to the downside. Okay, and what we have over here is another high. Okay, so just based on this, can you see we have one high here, one low here, we have a lower high. So in this case here, this would then be updated to be a lower high. Okay, and then we have established a new low right now that kind of broke that previous low. So then this also became what we call a lower low. Okay, so what you have right now, can you see that this is very clear at this current moment? It's a downtrend. Okay, because what we have a lower low, and at the same time we also have a lower high. Okay, so based on euro dollar 4 hour time frame, what we are seeing right now, we have a downtrend. Okay, we don't really care like what happened in the past, because at this current moment on this chart here, what's clearest to us is that we have a downtrend. Okay, so that's the first step. Okay, in 1, 2, 3, 4 strategy, the first step is to identify the market conditions. Are we in a trend or are we in a range? So in this case here, we are in a downtrend. Okay, now what does this immediately establish is that if the market is in a downtrend, we will only be interested in sell opportunity. Okay, that makes sense, right? I mean, the market is trending lower. There's no reason for you to go and look for buy opportunity, but instead, you want to look out for sell setup. Okay, so this trend kind of establish what we call a directional bias as well, which means right now you're only focusing on sell opportunities. Okay, now the second step on this strategy over here is to then establish what we call structure levels. Okay, now once you're able to very clearly identify lower low, lower highs, this points here, okay, your structure becomes very, very easy and straightforward. Okay, everything builds up from this. Okay, now each of this turning point, okay, we can see here, this is a turning point, right? Each of this turning point becomes a clear structure level. Okay, so if I'm gonna use like a ray line here, okay, I'm gonna establish some points. Okay, you can see I'm just gonna put like horizontal lines on this level here. Okay, this starts to establish what we call structure levels. Okay, and we will have 4 horizontal ray lines because we have 4 points. Okay, and what you can also start to put in over here is that you can, instead of like high, low, lower low, lower high, you can start to put it in terms of number. Okay, and that's what usually I like to do to simplify things, right? So we can turn this into what we have over here as a 1, 2, 3, 4. Okay, and that's where the name comes from, right? So now you should be able to know why we call it 1, 2, 3, 4 strategy. Okay, now this is the second step. You want to establish the structure level. Okay, and all you do is basically utilizing that pivot points, that turning points, right? Your 1, 2, 3, 4, they are all structure levels. Now this is important because it can't act as a support and resistance zone. Okay, now it's not going to be perfect all the time, but that's the key area that you really want to pay closer attention to. Okay, so now what we have established is that the current market condition is in a downtrend because we have a lower low, lower high. We have 1, 2, 3, 4 pointing to the downside. We have identified the structure areas that we want to keep an eye on. Okay, those are all your turning points of your 1, 2, 3, 4. Okay, and we have also established that the direction we want to focus in trading is to the downside. Now, once you have done all that, the third step is basically quite straightforward. Okay, we want to identify where should we get involved, how do we put our stop loss, how do we put our take profit. Okay, now in this case over here, I'll clean up a little bit in this drawing first. Okay, now we have established our structure, right? We have established our 1, 2, 3, 4 points. Okay, the third step is to basically identify areas in which we can get involved. Okay, and I like to use a lot of fibs in some of this analysis and methodology over here as well. Okay, and I'll be using the Fibonacci retracement tool. Okay, very easy. How you're gonna pull it, because we already have this label 1, 2, 3, 4. You're gonna pull your fib from third point, okay, all the way to your fourth point. Okay, and what we essentially want to find out is there a significant confluence of Fibonacci retracement ratios versus our structure? Okay, now I think this one here is super clear and super straightforward. If I were to clean this up a little bit and just leave the 50%, okay, you'll be able to see that 50% came very, very close to our 0.2, right, which is where the previous structure level is. And that was previously a support. It has broken to form our fourth point here, and therefore this will then turn into a resistance. Now, in other words, we are in a downtrend, we are looking to sell, and if price were to retrace back towards this area here, we'll be expecting there's a higher chance market will continue to move lower. Okay, so that's the principle of this. Okay, so which are the area we're going to keep a very close watch? Naturally, it will be this zone here at the 50%, where it confluences very, very nicely with our previous structure level, okay, which is 0.2. Okay, so then this area becomes our entry, okay, our entry zone, right? Which means that if price were to retrace back towards this area, we'll be looking for a sell. Okay, now how you're gonna get involved in it exactly? Generally, there are two types of entry. One is you put in a pending limit, which means that you just simply wait for a retracement. If price were to retrace and touch this level, you get involved in the sell trade automatically. Now, the other way is some of you might be maybe more comfortable with some kind of confirmation like price action, like waiting for a pin bar, waiting for a bearish close at the area before you jump into a trade. That's possible as well, right? Again, there's no such thing as perfect. There's no such thing as which one is right. You need to then fine tune like which one suits you a little bit. Okay, for today's purposes, we're just going to keep it simple. Okay, and let's say that this is the area we identify. We'll just put in the pending limit to sell it, right? When price kind of reach this area here around 1.1520. Okay, so we're just going to keep that as simple as that. Okay, so now once we identify that, okay, this is our entry to sell it. Okay, obviously we need some kind of risk management and we need to identify like where we want to put our stop. Okay, a very conventional way to put our stop, of course, is at the previous high. Okay, and that would be our stop loss. Okay, which is 0.3, right? Because 0.3 is where our previous high is. So again, all this number comes in a little bit handy, yeah? So in terms of stop loss, then the price point here on that high is going to be at 1.1608, right? If you just round out a little bit to add in that spread, it becomes 1.1610. Okay, so again, we have identified the area we want to get involved in. We have identified, okay, where our stop potentially can be. Okay, which means that if price were to retrace back but did not bounce and go lower, instead it keeps going higher. Okay, at this point, when price is able to break through the 0.3, okay, it's no longer a downtrend. Okay, and that's the reason why I want to get out. Okay, because the downtrend is no longer valid. Any sell trade, we're not going to be involved in it anymore, right? So that's why we set our stop loss at that level. Now, how do we set our target? Okay, over here, of course, you can utilize the simplest way, which is just to look at 0.4, okay, for your take profit 1. Okay, so in this case here, you can set this as TP1, okay, your first target here, and the price point would then be somewhere around 1.1435 if I were to round a little bit. Okay, now in this case here, your risk reward is somewhat about 1:1. Okay, because we're entering at a halfway point, right? 50% fit. Okay, so that's about 1:1. Now, some of you might want to go for extended target. Okay, and in this case here, we can utilize a little bit of the Fibonacci retracement or extension. You're gonna pull it in the opposite direction right now. Okay, so just now we pull it from 3 to 4, right, to find our entry confluence. Now, in this case, if you want to find a target, we're going to pull the opposite direction. We're going to pull from 4, okay, to 3. And the level that you want to look up for is the 127.2. Okay, so in this case here, you can see that's where the fit level is. And that will then become your take profit 2. Okay, and in this case here, let me just put that in. That would be around 1.1385. Okay, that becomes your target 2. Okay. Now, if I were to add in this on TradingView, we are able to do this, right? Just to draw in for you to see very clearly. Okay, so your entry, your stops, and of course your target over here, if I base it on TP2 level. Okay, so that's how we set up for a 1, 2, 3, 4 strategy, right? Because number one, again, recap, the market is trending down. We're only interested in the sell. We have identified our 1, 2, 3, 4 points. We have identified the structure level, which means that these are the areas we want to keep an eye on. We have put in a Fibonacci retracement as well from 3 to 4 to kind of find, is there any confluences with our previous structure? Right? So in this case here, Euro dollar, we identified that the confluence is happening at a 50% Fibonacci retracement. That is where our entry is going to be. Okay. The stop loss on this here, we're going to put it at the previous level, which is 0.3. And our target over here will use the 127.2 Fibonacci extension, where we pull from 0.4 to 0.3. Okay. Now, if you want, of course, customize this a little bit, we're able to do that as well. Okay. So if I maybe, bring this Fib retracement, I'll add in a 786 Fibonacci. What I can do is I can actually reduce my stop slightly, okay, to put it instead of 0.3, I can actually bring it to like the 786 Fibonacci, and that will put us at 1.1570. Okay, now what is the advantage of doing that is that when we reduce our stop loss with, okay, you can see the risk reward right now increased to 2.5, which means if you're risking 1% and you hit your target, this trade can give you a 2.5x return. Okay, Now, if I were to put my stop loss at 0.3, you realize that the risk to reward ratio is just 1.5, which means every 1% I put in, if it hits my target, I'm going to make about 1.5% in return. Okay. So each of it has its pros and cons. Of course, I'm just sharing you the variations of which you can customize it. Okay, and this is one way you can do that as well. Okay, to kind of increase your risk to reward ratio. Okay, so this is on euro dollar. It's in the downtrend, and therefore this is the setup on that, right? If we were to look at, let's say, let me identify one. Okay, let me give you an example of maybe not the best environment to trade. Okay. Okay, we'll come back to dollar CAD later. Okay, but now let's say we look at this. Okay, I'll bring you to like 1 hour on Aussie yen. Okay, now if you take a look at Aussie yen, okay, just to show you an example of what is not the best environment to kind of use the 1, 2, 3, 4 strategy, and you might not get a setup anyway. Okay, so if you take a look at it right now, right, this is where the market currently is trading. Okay, before it reached this high, it was at this low, so it actually came up. Before that, it came down. Before that, it went up, right? So in this case here, if you start to establish that, okay, this would be your first point, okay, or I can start with where we are right now. This is our fourth point, okay, and then of course we have our third point over here, okay, we have our second point at the top over here, and you start to realize that in this case, our 1, 2, 3, 4 is not in a trend, okay, because while this is a low, we do have a high. We have a higher low, but at this moment, we do not have a higher high. Okay, price has not broke that level yet. So in this case here, you can see a 1, 2, 3, 4 is not having a higher high, higher low. It's not having a lower low, lower high as well. This is not a trend. Okay, at least from this market condition. So when you identify something like this, for example, a Aussie yen on the 1 hour time frame, you just skip it. Okay, because there's no trend, you do not want to trade it. Okay, now let me bring you back to dollar Canadian. Okay, so if you take a look at dollar Canadian, right now we are here. That was this established point. This is where we are right now. Okay, so we can start to see, okay, if this is the highest point that's established recently, okay, that's our fourth point. We start to count down a little bit. Okay, it came from this low, so that becomes 3. Before that, this was the little mini high 2, and then of course before that it came from the bottom over here. Okay, so in this case, can you see we have a very clear, from the low 1, 2, 3, 4. Okay, and we have a high, 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 low. In other words, on this scale here, dollar Canadian is uptrend. Very clear. Okay, so that again suggests that our directional bias is more of like looking for the buy setup. Okay, and we start to establish some structure level. Okay, so we start to put in a horizontal line at each of this point here. Okay, and next up, we're going to pull in our fib from 0.3 to 0.4. And we start to see, okay, that confluence, right, comes in. Maybe I'll use the 618 because 618 seems to be closer to our structure level. Okay, so over here, you can see, right, so we're going to use that Fibonacci 61.8 retracement level. Okay. That would become our entry level. Okay, and of course the stop, I can put it at below 0.3, or I can utilize the 786, again, depending on, which one I'm comfortable with. And then your target, of course, you can place it at 0.4, okay, or you can use your Fibonacci extension. You pull it from 4 to 3, okay, and you'll be looking at the 1, 2, 7 extension for your target. All right, so not too difficult. Again, it's a pretty straightforward strategy, okay, that is best utilized when it's, I call it trending environment, okay. So again, you can utilize this on any chart, any instrument, any time frame, but I always suggest if you're fairly new to trading, right, don't go below 1 hour, okay. To me, most traders are going to be suitable or comfortable trading the 1 hour and a 4 hour time frame. Okay, so I think over here, from today's strategy sharing, you can see that the practical usage in terms of this strategy and this technique over here, we do have a couple of setups, right? One is on euro dollar, looking for the sell. I think this trend is very, very clear cut. Dollar Canadian over here as well. Of course, we're looking at the uptrend here based on this 1, 2, 3, 4. It's also very obvious. Okay. Now, if some of you are looking at, let's say, gold, okay, I think you can utilize the same thing as well. Gold is obviously in an uptrend, right? So you can see this is where we are right now. This is 0.4. Okay. Before it established that high, it came from this low. Before that, the market actually came up here. And of course, before that, the market was at the low. Okay. So again, you do have that 1, 2, 3, 4 points. Okay. And where is it going? It's going higher and it's making higher high, higher low. Is obviously an uptrend. Okay, and the directional bias on gold, of course, right now you'll be focusing on a buy. Okay, and if I start to put in a little bit of all this structure over here, I start to pull my fips from 0.3 to 0.4. Somewhere around 50% is where that confluence really comes in, right? You can see that 50%, and then of course this area here. Okay, so that becomes your potential entry. Okay, if I'm gonna look at 786 as my potential stop. Okay, this is how it's going to look out. Okay, and of course my target, will be up there. I can actually utilize my extension as well, pull from 4 to 3, and then I'll look out for that 127 at the top over there. Okay, and my target can be something like that. Right, so this risk reward can be also like 2.5, right? Pretty decent, not too bad. Okay, so commodities market, you can utilize that as well. If you're trading on indices, okay, naturally you can do that. Okay, but sometimes you might look at it and the market is basically not in a trending environment. Okay, this is Hong Kong index. If you take a look at this is definitely not a trending environment, right? Because if you put here, this is where the market is trading right now. If this is 0.4, okay, you come down here, this was 3. Before that is up here, this is 2, and of course before that we have here, okay, which is 1. And you realize your 1, 2, 3, 4 is not giving you a higher high, higher low. It's basically in the range. You don't use this technique. Okay, can you utilize that on crypto market? Okay, the answer is definitely yes. Okay, so in this case, you can see over here, okay, in terms of Bitcoin, this is where your 4 is. Okay, this is where your 3 is. Okay, this is where your 2 is. And of course, 1 will be, you can utilize this here. Okay, so it's definitely trending up, right? Because you can see you have a high, you have a higher low, you have a higher high, right? The 0.4 break 0.2. But what's interesting is, okay, you realize that if I start to put in a little bit of a structure over here, okay, can you see 0.2 and 0.4 are basically very, very close to each other, okay? In other words, this is, yes, trending higher, but it's not a very strong trend, okay? So you might not want to pay attention too much on all this trade first until we get a very, very nice break. And, it can break this level, very obvious, and there's some room for it to come back. Where 0.4 can be up there, okay, versus 0.2 here, and then you see some gaps, right? You see that vertical gap. But right now you don't see that because 0.4 and 0.2 are basically at a very similar area. Okay, so something like that you also want to take away, or I say don't focus on the setup right now if you see a situation like this in terms of Bitcoin. Okay, so sometimes you might observe certain currencies, certain asset might give you a much better opportunity, much clearer setup. Why I actually talk about euro dollar first, because this is one of the clearest setup that you can see 1, 2, 3, 4. Okay, and that's something I want to highlight. Okay, depending on the time frame you look at as well, like right now, if you take a look at Aussie dollar, okay, if this is 0.4 over here, okay, and we start to establish that this becomes your 3, okay, this becomes your 2, and you have your 1 over here. What you then start to observe is that right now the current market price is somewhere around that level of 0.2, okay, And in this case, obviously, we are in the downtrend on the 1 hour scale because you have the lower low, lower high. And the market right now is testing our 0.2, okay, our previous structure. And if I add in a Fibonacci from 0.3, I pull it to 0.4. Okay, maybe I'll put in the 618 in this case here. You can see 618 and our previous 0.2 comes in very, very close. Okay, and therefore, for those of you who are keen, this becomes the area where you can look out for an entry. Okay, and of course, again, depending on how you want to put your stop, you can put it above 0.3. You can utilize that 786 as well in terms of Fibonacci for your stops, and your target can be at the bottom at 0.4, or you can even add in the 127 Fibonacci extension. Okay, so again, different time frame, you might see things slightly differently, right? In terms of like Aussie dollar on a 1 hour time frame, okay, this is a 1, 2, 3, 4. If I bring you to the daily time frame, then you might not see the same thing. Okay, now don't get overly confused by that, because some of you might start to say, oh, but 1 hour is a downtrend, but daily right now is not in the downtrend, right? You can see that daily, if we start to establish that 4 point, this would be 4. Okay, and then of course, if I start to count down, you can see we are technically on a daily time frame in an uptrend, right? Because this is where, okay, if I put it like that, you have your 1, 2, 3, 4 is going higher. Okay, and even if this retrace here right now, it hasn't break our 0.3. So technically, this is also a higher low. Okay, and if this continue higher, what we have a higher high, higher low, higher high, higher low. We are technically in an uptrend on a daily time frame. Okay, so why I say you don't want to confuse yourself with all this, because sometimes you might say, oh, 1 hour here, we're looking for the sell, but then on the daily time frame, this is an uptrend. How? Okay, of course, eventually it's important for you to go and consider what we call multi-timeframe analysis. Okay, where ideally, of course, you want your different time frame to align with the direction that you're looking at. Okay, so what is multi-time frame analysis? Basically, if you're looking at daily time frame for your higher time frame, okay, and then maybe your H4 here is your execution time frame, then what you want to do is, if let's say the daily and the H4 are both aligned, then yeah, maybe you want to take that trade. Okay, but in case where you see, okay, daily and the 4 hour, maybe they're not aligned, one is going up, one is coming down, then maybe you want to avoid that trade, or even if you're taking it, you might want to reduce your risk, right? So that's what you can do. Okay, so for example, like Aussie dollar here, you can see daily time frame, it's in an uptrend, but on the 1 hour time frame, there's a sell opportunity. What you can do, you can still take the sell, okay, but maybe you want to reduce your loss, right? Reduce your risk. Or if you're someone who is very conservative, and you're looking at daily for your higher time frame, 1 hour for your execution, then you do not want to trade that. Okay. If I bring you to euro dollar, you can see, 4 hour, we look at that sell on the daily. We also look at the downtrend, right? Because if I remove everything on the daily scale, this is also very obvious, right? You have this one, this one, this one, this one, right? So we are technically in the downtrend on the daily scale as well. Okay. So this is another layer of, I would say, confluences that you can actually use to help you in that trading. Okay, so yeah, that's the strategy that would like to share with you. Okay, it looks simple, it is. Okay, but at the end of the day, you do not need a very complex strategy to start executing trades in the market. Okay, of course, there are always room for additional confluences, additional analysis, or even some advanced analysis. Okay, but in this series here, we want to focus something more of a simplified version. Okay, for you guys, especially who are very new, to at least have a proper framework that you can start using first. Okay, and then eventually all traders would need to customize their own strategy. Yeah. Okay, I see a question here from Yong, right, asking, is the interval between points preferred to be consistent or similar number of candles point to point? Not necessary. Okay, very good question over here. It's not necessary, but I would say visually, you want it to be, pleasing, right? You can see euro dollar is actually something that is very, very nice looking. Okay. Some of the, let's say I bring you to the yen, right? And I go to a lower time frame. Okay. Now, if you take a look at that on the 1 hour scale on euro yen, okay, is this a downtrend? The answer is yes, right? It's coming down. But do you see, like, it's not like the best, okay? You don't get a very nice this kind of structure, right? The visual part of things is not that nice, right? Because if I start to put it in this way, okay, let's say this is 0.4, okay, this is 0.3, okay, this is 0.2, and then of course, okay, naturally that will be 0.1. It is a downtrend, right? You can see that, okay, and the thing here is, okay, 0.2 and 0.4, of course, visually this doesn't look as neat and clean. If I bring you to even like dollar CAD, okay, can you see like dollar CAD when it breaks 0.2, it breaks off pretty obvious, right? It gives you that gap. It gives you like from 0.2 to 0.4, that is that very obvious gap. But in terms of like euro yen, you can see between 0.3 and 0.4, that gap, right? It's not wide. Okay, it's not wide. Like 0.3, 0.4 here, 0.2 here, right? The gap is not wide. Okay, can you still look to trade it? Yes, but usually when you see something like that, it's not pleasing. It's not visually very nice. I would say go for better ones. Okay, like compare euro yen and euro dollar. Both are coming down, right? But euro dollar is obviously way neater, way clearer as well compared to euro yen. Okay, so that's something you want to focus on. Okay, now of course, the 1, 2, 3, 4 strategy, I like to call it as one of the most objectified technique, because there's really not much of a guesswork. Okay, but in trading you can't be fully objective. Okay, because there's still that discretionary element. Okay, you can't take that away. Yeah, so I would put it like, I would say 80 to 90% of this strategy is very, very straight cut objective. 1 is 1, 2 is 2, 3 is 3. Okay, but there's still that element of discretionary, maybe about 10% of it. Okay, it still boils down to a little bit of your experience looking at the chart. Okay, so yep, I hope that helps, right? For those of you who are actually looking out for strategies to test out, you're looking for different ways of which you can actually look at the market and take trades. You can give this a go. Okay, back then when I got started, I think back in 2015, around that period. Okay, I'm solely trading on this method, and I can share with you that the results are there. Okay, of course, it's not gonna be always winning, because sometimes the market is just in range environment. You might not get any trade, or you might get stop out as well. Okay, but this strategy works, and it's very, very objective in a way. Okay, so for those of you who are keen, can give this a go. Of course, eventually you need to customize a little bit here and there to meet your personality, okay, your characteristics as well as a trader. Good. Okay, so I hope today's session here to introduce you to this strategy and this technique does give you, I would say, an additional toolkit and in your library of strategies. Yep. Okay. So good. That's all from me. I hope it's been clear. Okay. That's the objective of this sharing. Okay, yeah. So for those of you who are keen, next week we'll be having another one. I think in November, that will probably be the last one in this series for November next week. Okay, so do join in if you're keen. Okay, and I'll see you guys on Monday. Bye bye.